Business Morning live on Channels Television. Thank you for joining us. I'm Ladi Williams.
And I'm Chimezie Obi Iwagu. Good morning and thank you for joining us. Well, we kick off with March inflation figures, which came in this morning at 18.17% year-on-year. This is 0.82% points higher than the rate recorded in February 2021. Which was 17.33%. On a month-on-month basis, the headline index increased to 1.56% in March. This is 0.02 percentage points higher than the rate recorded in February. The urban inflation rate increased to 18.76% year-on-year from 17.92% recorded in February, while the rural inflation rate increased to 17.60% in March from 16.77%. The composite food index rose to 22.95% in March compared to 21.79% in February. On a month-on-month basis, the food sub-index increased by 1.90%, up by 0.01% points from 1.89% recorded in February. Now, this rise in the food index was caused by increases in prices of bread and cereals, potatoes, yam and other tubers, meat, vegetable, fish, oils and fats and fruits.
And the all items less farm produce, otherwise known as the core inflation, which excludes the price of volatile agricultural produce, stood at 12.67% in March 2021, up by 0.29% when compared with 12.38% recorded in February. On a month-to-month basis, the core sub-index increased to 1.06% in March, and this was down by 0.15% when compared with 1.21% recorded in February 2021. In March 2021, all items inflation on the year-on-year basis was highest in Kogi State at 24.51%, Bauchi with 22.24%, Sokoto with 20.70%, while Imo was at 16.08%, Kwara 15.34%, and Cross River with 14.45%. Which recorded the slowest rise in headline year-on-year inflation. Food inflation on a year-on-year basis was highest in Kogi State at 29.71%, Sokoto with 27.02%, Ebonyi with 26.59%, while Abuja had 20.10%, Kebbi at 19.98%, and Bauchi State at 18.61% recorded the slowest rise.
All right, we'll get the first word on this latest inflation numbers and how investors will react to it from the head of research and strategies at Cordros Securities, Jolomi Odonro, in a moment. Keep it here with us on Business Morning.
And Jolomi Odonro joins us now to give us more insight. Head Research at Strategies at Cordros Securities. Hello, Jolomi. Great to have you.
Good morning. Thank you for having me.
Good morning. So the inflation numbers came in higher this morning as expected, but did you anticipate this level of rise at 18.17%?
Yes, we did. Our forecast was actually at 18.24%, expecting about 1.6% month on month. So this was, largely expected. So far in the year, what we've seen is, pressure when it comes to food producing states due to insecurity in that region, as well as limited gains from the reopening of the border. And so it was expected that we're going to see rising inflation, and our expectation is that we're going to see that all the way through to June, when we'll see the peak. Thereafter, we expect that the base effect will come into play in July, and the harvest season in around September should lead to a moderation in the second half of the year. However, for now, we're going to see rising inflation numbers. Looking at what we expect for the rest of the year, we expect inflation to end around 16% by December 2021 and average 18.06% for 2021.
Now, looking at the figures, we see that all the four parameters have moved in the same direction, the core, food, headline, and even the month-on-month. Now, CBN has often said the cause of inflation is an output problem and not money supply. Now we have seen this trend. Would you say it's an output problem or money supply or both?
No, it's obviously not due to money supply. The issue surrounding the food basket, are well versed. Coming from last year, we had the shutdown on the borders, and you have a significant amount of insecurity in the food producing belt in the country. So that is what exerted a significant amount of pressure on that side. And for the core inflation side, we also know what's been going on with the VAT increase and tariff hikes, as well as the PMS price adjustment that has been rolled back. So, those are the major problems, or those are the major pressure points on inflation, as opposed to a significant rise in N2.
All right, the rate of inflation has gone 100% above the inflation ceiling of 9%. Average African inflation is 8%, and we're 10% above that. What do we do to stem this tide?
The issues around inflation are structural, and it's going to take a while to cause a serious correction. Don't get me wrong, these numbers are alarming, and it's something that really, really needs to be taken quite seriously and focused on. But again, it takes concerted effort from both the monetary and fiscal authorities to arrest the significant rise we're seeing in inflation. But it's not going to be a short-term fix, not possible.
Now, do you think it's now time for the central bank to perhaps increase the interest rates? So how long can we continue to maintain a low interest rate?
We've already started to see signs that we're going to move towards a more hawkish stance. Yes, the MPC then notes that at the last MPC meeting that inflationary pressure was a concern. But now what we started to see, our expectation was always that we're going to see a hike at the end of the first half of the year in the May meeting, and we maintain that position. And signals already from how the Treasury bills markets are trading. The PMA option yesterday is already up to a 9% discount rate on the 1-year Treasury. It points towards an overall switch from the lower for longer mantra we had at the tail end of 2020 more towards a hawkish stance. And we do expect a 50 basis points increase in the May meeting, and overall a 100 basis points increase in the monetary policy rate for 2021.
All right, let's look at this from an investor standpoint. How do you expect bond investors to react to this news, and what is your outlook for the rest of the year?
For bond investors, if I look at it from a fundamental perspective, looking at the term structure of interest rates, a rise in inflation and a rise in the base interest rate should lead to a higher risk-free rate. So bond investors are going to be demanding for that. You add to that rise in inflation and the impact on real return, you should see bond investors also requiring higher rates for that. So all in all, looking at the yield environment, it should lead to higher yields. And that is what we've seen so far this year. You add to that the announcement that they were looking towards securitization of the ways and means balances, and the need to allow interest rates trend upwards so that investors would be able to buy those bonds. So looking at everything, all the dynamics in the market now, it does point towards higher yields in the fixed income market, but then it's also tethered, or there's also a second side to that. If we get to a point where you have issuances of the euro bonds, which should take care of the foreign borrowings leg to a sizable amount, and then you also have the government enacting the tenets of the Finance Act 2020 to borrow from dormant account balances as well as unclaimed dividends. I know that's being challenged at the moment. Then you have a significant amount of domestic borrowings also taken care of, in which case there would be a demand-supply imbalance such as we saw in 2020, and then yields would trend downwards. But all those factors I just mentioned are still over the horizon. For now, all the factors point towards higher yields for investors over at least the first half of the year.
All right, we have seen the inflation trajectory going higher, and of course we're talking about the federal government talking about still borrowing, going to the Eurobond, and they're planning to borrow about $3 billion in the Eurobond market. Now, seeing the rising inflation here in Nigeria, and of course, the inflation number in the U.S. just came out and tended higher above the 2% band. Shouldn't this be a worry?
I mean, if you, it's. I mean, if I say the worry for me would come from the significant amount of financing you're seeing, or the significant high cost borrowing you're seeing at the moment. But if we look at the Eurobond market, or I mean, if I'm getting your question correct around where the yields would drop, I mean, Ghana just issued a Eurobond that was very, very oversubscribed. And yes, the yield was significantly higher than it would have been in the prior year, given that inflation in the US is rising, like you mentioned, 2.4% at the current time. So, I mean, yes, you do have a situation where you are increasing your um, interest or cost of debt significantly, but it's also a situation where you have to plug the fiscal deficit. And right now, I think that's the more concern for them right now, given that there's still quite a bit of way to go get um, to cover the fiscal deficit when you look at income legs as well as the expenditure leg. So yes, it is worrying given that we've expanded our external debt so significantly over a short period of time, and then issues around debt sustainability will come to the fore eventually, obviously.
All right, Jolome, are there factors or events to watch out for that could bring some respite to the upward movement in yields? And how should investors align their positioning on the yield curve, given those factors?
I mean, for us, like like I just mentioned, there are some factors to watch out for. I would say the most significant of these factors would have to be that could obviously cause a reversal in the trajectory of yields is if the government can borrow significantly outside of the market. And like I did mention, on the external debt side, there was no plan to issue a Eurobond this year. In fact, the Eurobond that matured at the start of the year was allowed to mature without a rollover. And so now we're seeing the government come to say they would borrow a Eurobond. If multilateral financing comes from the World Bank, AFDB, or any of this other multilateral agencies, then external debt leg is sorted out. The second part comes from the Finance Act. The Finance Act, it's in there that allows the government, or the government should be able to borrow from dormant account and balances as well as unclaimed dividend to the tune of 895 billion. So far in the year, the government has done about 650 billion in domestic bond markets. If you add that, if that comes to pass and you add that, then all of a sudden you have significantly lower borrowings from the domestic leg than you would expect. Add to that higher crude oil prices, then all of a sudden you wouldn't be seeing such a significant supply in the bonds market. That would cause a reversal in the trend that we've seen so far in the year, because right now the government has to significantly borrow, and so the DMO is coming to borrow at increasingly higher yields. If that changes, then we'll see a reversal in the yields. But for now, all signs point towards higher yields, and so it's advisable that investors, if they must stay in the market, either go short or stay at the short end of the curve. That way, they're not too affected by the significant movement in the yields. For those investors that don't have a trading objective, this is a good time for them because they're seeing yields of about 14% at the long end of the curve, which means that they can lock in those substantial yields over a long period of time. Now, I do believe that those investors should look at this because at the end of the day, we don't see yields trending significantly upwards from this point. If the reason why the DMO has let yields trend to this level is due to the upcoming or their plans to securitize the ways and means balances of the CBN, then it doesn't make sense for them to do it significantly over the cost at which the government is currently carrying that debt. And that the cost to the government at this point is MPR plus 300 basis points, which is about 14.5%. So looking at where the long end of the curve is now and where that borrowing cost is, I don't see a lot of movement beyond that point. So investors looking to lock in at that level would be attractive. So that covers both the trading investors as well as investors looking to hold over a period of time.
All right, that takes us to, of course, what happens at the equities market. Now, considering the full year 2020 earnings season, which tempered market reactions to rising yields and the first quarter has come to an end, do you expect continued sell-offs in the equities market and, of course, given this trend in inflation?
So I mean, for equities market or looking at dynamics between the fixed income and the equities market on the base case, everyone would basically just say as yields rise, equities market performance always drops, and that's I mean the reason for that is because investors will take a high risk-free yield um, over the uncertainty of the equities market, and this will continue even though the argument is far more nuanced than just an interest rate play. I'm looking at the equities market. The truth is that yes, if you look at most of the companies in the market, you say that revenues should increase given increasing real growth as well as the inflation given a backdraft to that revenue growth. But then inflation also has an impact on margins, which means that earnings growth may not be as strong for a lot of companies that may not be able to pass on the cost to their customers. So looking at equities market performance in this current dynamic, I would say that it's overall more negative. Um, and so I would expect to see equities market performance continue to lag while we have interest rates at such levels as we do right at this moment.
All right, thank you very much, Jolomi, for sharing your time with us this morning. We do appreciate it. Thank you. Enjoy the rest of the day.
Thank you very much.
And more on the rise in inflation numbers as we look at the commodities market update next. Keep it here with us on Business. All right, looking at the commodities market as inflation trending higher, we have Desola Sumoni here, one of the financial research analysts at Financial Derivatives Company. Hello, Desola. Good morning. Good to see you.
Hi, Chimizie. Good morning, and thank you for having me on the show.
So we have the March inflation data this morning, and well, still looking higher at 18.17%. Well, you had predicted kind of 17.8%. This is way above your prediction. I mean, are you worried with this trend?
Thank you for that question, Chimezie. We predicted 17.8%, like you said. We're directionally correct, but I think we were a little more conservative in our forecast. I think at this time, inflation is now, more than double the central bank's upper limit, which is a cause for concern. It has increased for 19 consecutive months, which is again a cause for concern. And I think that the central bank's argument that the drivers of inflation are more structural, I think it doesn't hold water anymore, because now I think all factors need to be on deck. And I think that the fact that inflation is now at 18.17%, I think it would strengthen arguments for a hike in interest rates. We're expecting that anytime. We're expecting that probably not in the coming meeting, but we are seeing change in sentiment among the MPC committee members. We are seeing at the last meeting in March, about a third of the committee members voted for a hike in interest rates. So with this, with inflation currently more than double, the central bank's upper limit, I think it will strengthen the arguments for a change in monetary policy stance. I think towards what's it now, H1, I think we should see a hike in interest rates, in the benchmark interest rate. And also, if you look at the neighboring countries, or if you look at our peers, Zambia, for instance, they have inflation at 22.3%, and at the last meeting, they also increased their interest rate to try to stem the tide of higher inflation.
All right, well, in the U.S., headline inflation rose by 0.9% to 2.6% in March, and that's the highest level since November 2009, and 0.6% above the Fed's upper limits. And the U.S. Fed Chair, Jerome Powell, had always downplayed this. But what are the implications of this development for emerging market economies like Nigeria?
Thank you. Like you said, inflation in the US currently at 2.6%, which is higher than analyst expectations of 2.5%, and mainly was driven by a host of factors. One is base year effects compared to March last year when the US just went into lockdown and prices were tanking. That's why part of why we are seeing inflation this high. But also there's this pent up demand as many states in the US begin to lift up coronavirus induced lockdowns. We have trillions and trillions of stimulus hitting the economy at the same time, and we see that because of the supply chain disruptions, many companies are struggling to keep up with demand, and that's part of why we are seeing prices higher. And one of the major drivers was price of gasoline. Also, as more and more Americans begin to drive now, like you said, the Fed Chair Jerome Powell strongly believes, as well as White House economists strongly believe that inflation in the US is still anchored at 2%, and which is in line with their inflation target. But market economists beg to differ. They feel like this rise in inflation would probably change inflation expectations, and if that happens, I think it's going to have significant consequences for emerging markets. On one hand, if that happens, if the inflation expectation changes, I mean, some market analysts are expecting inflation to reach 3.5% or 4% in 2021. Meanwhile, the US Fed, thinks that inflation will average 2.4% this year. So, but if this change in inflation expectation materializes, then then the US Fed may have to tighten quicker than expected. At the last meeting in March, the US Fed said they don't expect the tightening cycle to resume before 2024. But if inflation expectation changes, then we might see tightening cycle happening as early as next year. And if that happens, I think it affects our emerging markets through two main channels. One channel is capital flight. So because of higher interest rates in the US, which will affect the yields on other asset classes in the US, it would attract capital away from emerging markets into the US. So that's on one hand. On the other hand, higher interest rates will lead to stronger US dollar, which would affect dollar-denominated commodities such as oil, which would dampen the demand for oil, and that is also not good for Nigeria.
And that also brings us to the issue of Nigeria's planned Eurobond borrowing, the planning to borrow about $3 billion dollars in Eurobond. Now we are having this rise in inflation both in the US and Nigeria. So what would that now mean for Nigeria's debt servicing?
I think that let's talk about the good part first. The good part, the funding is to help plug the budget deficit, which is currently 5.6 trillion for 2021 financial year, and then the Eurobond, if when issued and if successful, it will help, the external reserves accretion, it will help strengthen the exchange rates. But like you said, with inflation increasing, and we expect that, we expect the policy response to that, which will be higher interest rates. I think that would increase the cost of, this borrowing, and also with Nigeria's external debt increasing by, I think, if increasing by $3 billion, I think that will also increase Nigeria's debt service burden, and overall, I think it will increase debt servicing costs if we see a policy reaction in terms of higher interest rates in response to rising inflation.
And the CBN has resumed the dollar sales to foreign portfolio investors to clear some of the $2 billion backlog. How would this development affect the exchange rate in the near term, and also considering the rising inflation?
I think it's positive that the central bank is beginning to, sell some FX into the market to clear some of the backlog. I think it helps the foreign portfolio investors to gauge, the mood of the central bank. I think it will also help the naira to strengthen in the parallel markets, both in the INE market and also the private market temporarily. However, there's still these fundamental issues that remain because if the foreign portfolios investors, I think they are still maintaining tentative positions regarding Nigeria. They're looking at how the policy situation unfolds. And also as countries around the world, open up, lift up coronavirus restrictions, I expect that, there'll be more and more demand for FX, which would which would keep whatever appreciation we see, will keep it bounded. So I think that we might see the exchange rate appreciate, but it will be bounded. On the positive side, also we are seeing higher oil prices, which would increase external reserves accretion, and we're also seeing if the Eurobond goes through, like we've seen. I think Ivory Coast issued 1 billion in February, and it was oversubscribed. Ghana also issued a 3 billion euro bond last month, and it was oversubscribed. So I think Nigeria's 3 billion euro bond also would be oversubscribed, and that would increase external reserves. So I think those are the positives for the exchange rate, but the fundamental issues remain, and that would cap whatever appreciation we see in the exchange rate.
Okay, let's look at it this way. We have the Ramadan, which has commenced, and domestic commodity prices are, of course, expected to increase due to the higher demand. But do you think these price increases will be inflationary?
Let me give you some numbers. So data from representative household surveys show that around 4.9%, 49%, I beg your pardon, to 53% of Nigerians report to be Muslims. Now imagine around 3/4 of those people, 90% of those people fasting and requiring fruits, staples to break their fast. So imagine all that demand hitting the market at the same time, and that's why we're seeing prices rise. I think that this price increase would feed into food inflation, which will also feed into headline inflation. So I think that it is inflationary, and there are studies that have actually shown that in the month of Ramadan, price increases and it affects inflation. I mean, studies not in Nigeria, obviously, studies in Pakistan, in Saudi Arabia have shown that these price increases are inflationary.
All right, talk us through the price movement in the domestic commodities markets and your near-term outlook.
Okay, thank you again. Like you can see from our slides, prices generally are trending upward, partly because of the Ramadan season, but also it coincides with the planting season. Like you can see, we are seeing the price of a 50 kg bag of gari increase by 18% to 15,700. We are seeing and a 50 kg basket of tomatoes also increased by 71% to 12,000. We are seeing a 50 kg bag of beans. The price of a 50 kg bag of beans increased 25% to 30,000. We're also seeing a basket of peppers increase 6.7% to 8,000 per bag. So generally, we are seeing price move trend higher. And also this coincides with the planting season, because during the planting season, commodities are usually scarce in the planting season. So that is also why we are seeing commodity prices trend higher. And I think that at least for what month are we? April, I think we expect this trend to continue throughout this month of Ramadan.
All right, Desola. Well, another commodity there on the burning economic issue there is aluminium. The price of this commodity in the global market is up by 0.4%. That's the highest level since June 2018 on strong global recovery. Now, do you think this rally will persist in the near term or medium term? And what would that mean for the country?
I think it will persist. The overall sentiment in the global economy is that there's a strong recovery in economic growth. There's a risk a risk of sentiment in the global economy. We are seeing the United States economy grow sharply. We are seeing also forecasts the IMF also revised upward its forecast for the global economy to 6% in April from 5.5% in January. So overall in the global economy, we are seeing a recovery. Also, we are seeing the vaccination move at pace in advanced economies. And these are the factors that are driving, demand. And because of this strong demand, we expect that prices will continue to trend upward. Also, because of this, the coronavirus induced disruptions in supply chain. So, in the supply chain, we are not increase as fast as the demand for aluminum. Also, we are seeing strong demand coming from China, which is the largest consumer of this base metal. I've seen their imports data for March was significantly higher year on year and also month on month. So we think that this rally in the price of aluminum will persist in the near term. as far as this the outlook for global demand continues to remain strong.
All right, thank you very much, Desola. We do appreciate your time and enjoy the rest of the day and, of course, the weekend.
Thank you, and have a nice day.
All right, we'll take a moment. We'll be back. All right, let's do our opening call to the markets with Eddie Young Erwan. Well, Eddie, marginal gain yesterday.
Yes, Jimmy, you're right. Marginal gains. At least we'll say at least we've seen some gains in the market this week. But then those gains were largely due to the almost 10% increase on Guinness. And then we saw some interest in MTN Nigeria, although mild. And that was what helped the market yesterday, push the index up by 0.09% to 38,636.15 points, while the market cap was at 20.220 trillion naira. But to talk more about trading yesterday. Okay, we'll talk more with the trader. Volume activity level was mostly lower yesterday compared to the previous session. Now, volume was higher by about 33% at 278.04 million units, worth 2.27 billion naira, which was lower by about 21%. And all of that was traded in 3,989 deals. Now, UACN was the most traded stock by volume, as that stock traded about 32.6 million units, while Zenith Bank was most traded by value with about 431 billion naira. Sectoral performance was mostly negative. Now, the banking sector was down 0.20%. If you recall, we saw gains in the previous trading session on that counter. So investors were just trying to cash out on the few gains that they had made in the market. Consumer goods was up 0.23%. Like I said, that was due to the almost 10% gain from Guinness, and in all the other sectors were negative. But let's just talk more about the trading day with Afolabi Benro, a trader at Stanbic IBTC Stockbrokers. Good morning, Afolabi. Thank you for joining us on the program.
Good morning, Eddie. Thank you for having me.
So could you just walk us through what drove sentiment in the market yesterday?
So, for example, Guinness, like you mentioned, was up 9.96%. This is because over the past couple of days, the price had actually been dropping. So it was more like a correction of the trend that we had seen over the past couple of days. Elsewhere, the market was generally very quiet, mostly the banking sector driving activities. Again, most of the corporate actions have been done, and investors have already banked all these corporate actions in. So the market has reverted back to a quiet mode where it's mostly block transactions that are driving activities. But just to highlight that Guinness was basically on the back of the fact that they had lost points, over the past couple of days. So it was a correction of that trend.
So is the market still quiet at this time? And what should we be expecting, from trading today and tomorrow?
Yes, it's very quiet. I mean, the NTB results came out yesterday and the rates went up again. So that's not going to be very positive for the equities market. It's more likely that we'll see investors looking, away from the equities market towards, that space. So we expect that, it's been quiet since the open. We expect that it will probably be a quiet session, maybe outside of a couple of pre-arranged block transactions today.
All right, Afolabi, thank you for your input on the program. Have a lovely day. Afolabi Benro is a trader at Stanbic IBTC Stockbroker. So we'll just move on to the unlisted securities market, which has been on the rise lately, as the NSI was up 0.75% at 764.67 points, while the market cap was at 543.53 billion naira. We saw about 2.13 million units, worth 21.46 million naira traded in 4 deals. Now, we'll recall that NGX, which used to be the Nigerian Stock Exchange, now Nigerian Exchange Group, has been admitted to the NASD platform. So, of course, that's also what drove sentiment in that market yesterday. Now, over to the bond market. It sustained its bearish trend as we saw yields rise by about 10 basis points, currently standing at 10.9% or thereabouts. We had 41 deals in that counter worth 17.50 billion naira. Nigerian Treasury bills market, there was an auction yesterday, so investors are just paying attention to that. So hopefully today we will see some activity in this segment of the market. At the CBN special bills market, there were 8 deals worth 8.74 billion naira, while the OMO market was also bearish yesterday as yields expanded by about 12%. We had 15 deals worth 94.25 billion naira. But I mean, the yields in the fixed income space are rising. At the bond markets, we're seeing double-digit yields now, and we're seeing yields, or at the auction yesterday, the Treasury bills auction yesterday, we saw yields rise as well. But at the same time, these yields are nothing close to what inflation rate is at. So what options do investors have? Inflation is skyrocketing. I don't think salaries are rising as much as inflation is. So how much can investors actually invest when they're not getting yields as high as inflation? Well, Chimi, we just keep watching to see what happens.
That's a very good question to ask. So when you ask me to invest, I wonder where I'm going to get the money. If the salaries are not rising as much as the inflation is rising, I think that wouldn't encourage any investment. But we continue to hope for the best as usual. All right, we'll take a break, and when we come back, we'll check with London. This is Business Morning. All right, let's see what's happening in London. Juliana is here with us. Good morning, Juliana. The grain seal lobbying row is still making headlines. What's the latest on this?
Well, it's definitely intensified, Chimazie, and it all centres around the former Prime Minister David Cameron and his attempts to lobby government ministers as well as civil servants into providing COVID relief government funds to the now collapsed specialised bank. Yesterday, the Conservative Party managed to defeat a Labour move to try and look into what they call immoral, inappropriate, corrupt sleaze and cronyism. I think sleaze and the Tory party, pretty much a dirty terminology, because Sir John Major's Tory party was arguably pushed out because in the early 90s this was all over the British press, and it seems to have come back. It's not just David Cameron and Greensill. Matt Hancock, the Health Secretary, has also his name has been linked to a number of media individuals within the UK about how certain PPE contracts were delivered to many of his friends. One of them was even one of his pub landlords. So it's intensifying. The vote yesterday was lost by the Labour Party. Boris Johnson, the Prime Minister, does insist that the formal inquiry, which is ongoing at the moment, is going to be solid. But opposition members and observers don't think that will be the case.
In the meantime, Uber has been ordered to reinstate 5 British drivers who were struck out from its ride-hailing app by robot technology. Tell us more about this.
Well, what we know is that these 5 or 6 drivers have been reinstated by a Dutch court. Uber's European headquarters are located in Amsterdam, and it really stems, it all goes down to their artificial intelligence technology, which we know is playing more of a crucial role in the workforce and in the gig economy in particular. There have been issues in the past where Uber drivers say that a lot of this technology that the Uber company uses sometimes do get it wrong, and when you've got hundreds of thousands of workers in your books, then that appears to be the case, and this is what the Dutch court has ruled. A lot of these drivers were struck off from riding with Uber because apparently they had entered their information in the system twice. Uber failed to acknowledge the court case, which is why the case has been overruled, and these drivers not only have been reinstated but were also compensated with up to €150,000.
Interesting. All right, aside from Uber, are there corporates or data to watch today?
Well, a few corporate stories, Deliveroo probably being one of them. This is the first time that they've updated their trading reports since they went public a couple of weeks ago. They show that in the first quarter of 2021, their online orders have more than doubled. However, they did strike a little bit of a tensive tone because, of course, people are out and about again here in England. So that means there could potentially be less orders in the time to come. A couple of redundancy stories. Yesterday, 500 British gas engineers lost their job due to an ongoing consultancy with Centrica, which is the parent company. And also it's been announced that Asda, the 3rd biggest supermarket here in the UK, may indeed be culling the roles of 1,200 people that work in their bakery as they're looking at the way people's consumer habits have changed during the lockdown.
All right, thank you, Juliana. We hope to talk to you again later in the day. Okay, let's look at the crypto market. Well, Ladi, Coinbase is now valued more than oil giant BP after stock market listing. How do you see that?
Exactly. Well, Coinbase making history in the crypto world at this moment. First exchange to actually go public. And that's a big deal in this market. The debut price was at $381, which put the company's valuation at almost $100 billion. So Coinbase is doing it big at this point, and the market is reacting mixed. Bitcoin got a new high yesterday, about 64,000, but settled about 62K at this morning. Market cap, $2.24 trillion, down about 0.66%. 24-hour volume, $219.99 billion traded. Bitcoin dominance still keeps slipping, down 52.86% this morning. Bitcoin price at 8 a.m., 63,210, down about 2% from yesterday's highs. 24-hour volume, $74.838 billion traded. Ethereum holding on there, $2,478, up about 4.20%. Surprisingly, not following Bitcoin's retrace. 24-hour volume, $36.217 billion. Let's look at the top alts by market cap. BNB had an incredible run, down about 5.78. It got to about $600 in the previous rally. ADA, Cardano at $1.45, down 3.72%. Let's talk to Rume Ofi now, the crypto market analyst. Hello, Rume, how are you doing?
Good morning, Ladi, and good morning, Nigerians. Nice
Good morning. So, yeah, Coinbase finally gone public. How do you see this price and valuation of Coinbase?
Thank you very much. I think Coinbase listing, for me, is a shift in legitimacy for crypto. You know, for a lot of affliction on cryptocurrency generally, I think Coinbase is actually leading to make sure that a lot of people see the reality. Considering the fact that, you know, there's a time Donald Trump actually came up to say Bitcoin and cryptocurrency are based on thin air. This just shows that people are purchasing the future, you know. That's very great.
Interesting. So how do you see the market's reaction? Bitcoin hit 64, now trading about 62K. How are the altcoins looking?
Wow, I think something significant happened yesterday. The fact that Coinbase listing was, I was really excited. It got to a point about $64,000 or thereabout, new all-time high, quite all right. And when the very nice thing about this all-time high is the Bitcoin dominance, which actually gives analysts like us, it points out to the fact that the altcoin season is going to be boom, was actually going down. Ordinarily, Bitcoin is moving up. The dominance is supposed to be going up for altcoin to die. But at this point, Bitcoin is moving up. The altcoin dominance, the Bitcoin dominance, I need to say, is going down, which means that in the shortest period of time, we'll see the altcoin boom that we have not seen in the whole history of Bitcoin. You know, and now that the market is about 62, a lot happened yesterday. Quite all right. There was this Bitfest exchange, Bitfinex, sorry, okay. Bitfinex exchange, where the hackers moved about 10,000 BTC at some point. So the coins actually moved yesterday out of that exchange platform. You know, all of those things have sentiment towards the Bitcoin market. And also, you know, the police the SEC has new chairman, and the SEC is an enemy to crypto at some point.
Hello, Rume.
And I know the market is going to do a lot. Yeah.
Okay. All right, Rume. What are you going all in right now? What altcoin?
Wow. This is really huge for me. I think I have bags in Ripple. I have a lot of bags in Ripple, and I also believe in Ripple for a long time now, from about 0.2, and I'm looking at decentralized finance, and you know, Ethereum is the powerhouse of DeFi. So I am actually shopping for the best DeFi project. Talking about Link is there. We're talking about some other very good projects like Band Protocol. Some other very, very, very fantastic one. Away from that, I was also involving on ADA, which is Cardano, and a new token, which I call my hidden gem. It's called NWC. I don't know if you've seen it on my status on social media. Yeah. It's really great. Yeah.
All right, Rome. Thank you so much for your time. Enjoy
thank you very much,
the rest of your day.
Yeah, thank you.
All right, there you have it, Chibi.
Yeah, Rome being quite bullish in a number of
on the
altcoins there. And now we have Coinbase. Listen, I'm sure we'll have to find or see a number of these young stars. You call them the Gen Zs, you know, like you come into the crypto market. But then we must warn, if you must play in the market, you have to be very cautious. You have to seek some financial advice from professionals.
From a professional.
So you don't burn your finger.
So you don't buy the top.
All right, that's it on the program. Thank you for watching. I'm Chimeze Obi Iwagu.
And I'm Ladi Williams. Thank you for watching.